The 10-year, 3-month yield curve just inverted for the first time since 2020. Netflix reported blowout earnings. The S&P 500 is sitting at the 200 moving average weekly. The forward PE ratios on the S&P is finally looking attractive. We have Tesla earnings coming up, as well as the rest of the mid caps to round out October. The bond market is still broken. The dollar index still remains high. Energy continues to inch higher. Where are we going? Where is the market going? What should we be looking at? Especially since the 10-year, 3-month inverted yield curve has preceded every recession going back to World War II. So much to get into, and I'll also give you my earnings plays on Netflix and Tesla as well. Welcome back to this week's edition of TA Tuesday. Let's get right into it. All right, let's first talk about the markets, then I'll get into the inverted yield curve and all of the other good stuff that we opened the video with. So looking at the stock market, currently we're sitting on the S&P 500 at the 200 weekly moving average. This is a pivotal level that we spent 4 weeks at. Now, aside from the 2020 crash, we have not fallen below the 200-week moving average since 2011. And on the daily chart here on the left, we're creating this violent descending wedge. Now, we have had some pretty massive bear market rallies throughout this drop. However, one characteristic that you might notice looking at my chart is that we hit the golden pocket and the resistance of this wedge each and every single time. So if and when we do get a bear market rally, because it is my belief that we will get another one as earnings season is approaching, and we actually just started with the banks first, and then we had Lockheed Martin. And then we just reported, as of the time of this recording, Netflix completely blew out earnings. And I will show you my Netflix play. We also have Tesla and the mega caps coming up. And it is my belief that what the Fed is doing, the monetary policy, has not yet hit the economy, especially if we are doing a look back. Because remember, Q3 earnings include earnings from July, August, and September. And so that is not enough time yet to reflect what the Fed has been doing. And if we take a look at things like the unemployment rate, which is still historically low, actually going down, and we take a look at the CPI, which is still elevated, and it's showing that it is peaking, but it is not really dropping, it's pretty evident that the Fed's policy is not really having an effect on the economy. And it is my belief that it's not going to be reflected significantly in Q3 earnings. And it won't be until Q4 earnings, potentially Q1 2023, where we will start to see a slowdown. So I do think we will be on the cusp of another bear market rally. I'm hoping that we get to this point. It is still not yet evident to me whether we will or not. I mean, just imagine if we do get earnings on, say, Tesla, on Apple, on Microsoft, on Amazon, and those earnings come in mixed. I don't know if that is enough momentum to push this high to get the SPY past 400 again. But I'm hoping we do, because it will present the opportunity to build a nice short position. Now, although some of the big banks are considered mega caps, a company like Lockheed Martin could be considered a mega cap. Really, Netflix is one of the darlings of the mega cap group because it used to be part of FANG. FANG was actually how the stock market talked about the biggest tech stocks in the equities market, although Netflix has lost a lot of value since achieving that FANG status. So after hours, we see that Netflix went from 240 to 275. Whether this price holds up when the market opens or not, I'm not sure. However, we did play a neutral strategy on Netflix, and I will share it with you here before we move on. What we ended up doing with Netflix is we bought a double butterfly spread because I didn't have enough information to determine what direction Netflix was going to break. Was it going to beat earnings and surprise to the upside? Was it going to miss earnings and hit the low side again as usual, as it has done the last few earnings? So I decided to play a neutral strategy, expecting a big move in either direction. But buying something like a strangle, not only is it expensive, but it is subject to violent theta decay as well as IV crush. And Netflix's average IV crush is 25%. And for those that don't know, IV crush is very bad when you are trading options, especially with short-term expiries. It means that the implied volatility drops massively, which then drops the price of your option. So I didn't want to play something like a strangle. I ended up going with a double butterfly because a butterfly spread is way more favorable to both theta and IV crush. There's barely any IV crush when it comes to a butterfly. Now, we needed Netflix to be above 260 or below 220. As I said, after market is currently trading at around 274 and change. So that double butterfly spread should actually be very profitable if we expire end of the week at that range. I'm also planning on playing Tesla earnings. I'm not sure yet how I will play that. That is tomorrow as of the time of this recording. But if you want access to all of our trades, our analysis, long-term, short-term options, futures, etc., hit that link in the description. There are only a few spots left for October before those spots are taken, and we have to reset again in November. We also had a nice earnings play on American Airlines, which beat, and we are currently up 25% on that as well. Let's get right back to the analysis. So for those of you asking whether you should buy stocks here, here's the way that I look at it. Not only are we sitting at a pivotal level on the weekly, the 200-week moving average, which historically, if you just took this 200-week moving average, let me just pull it up again, and you went back in time, any single time that you bought stocks at the 200-week moving average, you made money in the long term. Now, buying stocks during a bear market, you are much more likely to see gains quicker, usually within a year or less, than you would if you had, say, stopped buying stocks out of fear, waited until the market recovered, and then started buying again. Over the last 30 years, if you just missed the 10 best days in the market, then your gains are actually cut in half. So not only are we at the pivotal 200-week moving average, but usually, if you end up buying at a 50% retracement from the last bull market, which we actually hit almost exactly at the 200-week moving average, and I'm talking about this bull market here from the bottom of the 2020 crash, we are almost exactly at halfway in between. Historically, that is where most bear markets end. Now, I personally don't think that the bear market is over for a number of reasons. Let us jump into the 10-year, 3-month treasury inverted yield curve. This currently means that the 3-month treasury is paying more than the 10-year treasury. Yes, you heard this right. This yield curve is now inverted, meaning it's negative. And if you look historically, this has inverted every single recession going back to World War II. This has preceded every single recession going back to World War II, this inverted yield curve. And the average time that a recession follows this is 6 to 18 months. Now, some will argue that we are currently in a recession because we achieved a technical recession with the back-to-back negative GDP quarters. However, unemployment is still historically low. Inflation hasn't really come down, and neither has spending or demand. So until we get demand destruction, until unemployment starts ticking up, I don't think that the National Bureau of Economic Research is going to deem this a recession until we start seeing unemployment tick up. Because what if we get the next GDP quarter and it's actually slightly positive? Then we will technically not be in a recession anymore. So I think the National Bureau of Economic Research, which is made up of 8 independent economists, conservatives, and liberals alike, have not yet deemed this a recession. But this inverted yield curve has preceded every single recession going back to World War II. And there's no reason to think this will be any different, especially since the Fed has a lot of hiking left to do. If you look at the federal funds effective rate minus CPI, we're still in the -4 territory. And the Fed is not going to stop hiking until the Fed funds rate is above CPI. The only way that they would pause or pivot is if the economy completely collapses. And we've never seen a bottom in the stock market while the Fed is still hiking. So I do believe that the Fed has more hiking to do. Obviously, I think we are going to be in a broad-based recession. I believe there will be more demand destruction. And I do think that the sentiment the economic sentiment that, that we're talking about, the environment that we're talking about with high rates, with lower demand, hasn't yet hit company earnings and is not going to hit them for another quarter or two. So we could get a delayed reaction there and further downside in the stock market. But because I'm not Nostradamus, and also because historically this is a good area to start dollar cost averaging, there are a few blue chip names that I would be okay picking up here, mainly the indices, as well as companies that are the heaviest weighted in the indices, such as Apple, Microsoft, Tesla, Berkshire Hathaway. You can look at the SPY-V, which is the value index of the S&P S&P 500. You can look at dividend paying stocks. You can sell calls against high dividend paying stocks, which would increase your yield on those stocks as well. I will get into another video on my strategy for recession-based investing and trading. But yeah, I do think that this is an area to start deploying cash. In my opinion, do what thou wilt. As you know from previous videos, and if you're part of the academy, we started buying energy as soon as we hit this major trend line here. Energy is up around 15% since we started buying in. The only way that I see us going down further in the immediate short term is if we get a lot of disappointments on earnings in the mega caps. And then, yes, I don't think that we'll even see a bear market rally. However, based on some of the stocks that already reported, the bank stocks, Lockheed Martin, some of the airlines, as well as now Netflix, it looks like earnings look like they are in decent shape, at least for those companies. We'll see what the mega cap tech stocks yield. But I'm not trying to guess at this major level whether this is the bottom or not. And a lot of stocks are presenting a good 30-40% discount, opportunities that I would have prayed for just a couple of years ago. Now, looking at the forward PE ratios for the S&P 500, we are nearing low levels. We are currently at around 16 on the S&P 500. That is certainly lower than most of the time it has been during the bull market starting in 2011, and is actually telling us that the S&P 500 right now is not at overvalued levels. It is near fair value levels. It doesn't mean that we're not going to see a drop, but the forward PE tells us the S&P 500 is not inflated like it was back when the SPY was trading at near 480. However, during recessions and bear markets, this suggests that we do have a little bit more to drop. Somewhere in the 12 to 14 range is where I would suspect for the bottom of the bear market. Now, if we take a look at the 10-year treasury, I already showed you the 10-year 3-month inverted yield curve is already minus for the first time since 2020, which tells us that a recession is much closer than we think, a broad-based recession. But the 10-year is still cracking that 4 mark. And who knows if the Fed raises again on November 2nd, if they do another 75 basis point rate hike, it is my view that the 10-year will just completely shoot past that 4% level. And the reason why rapidly rising yield curves here, we could take a look at even the 2-year. You could see the chart of the 2-year actually looks very scary. But if you take a look at the 2-year and how rapidly it was rising since the same time last year, this is the most violent rise I think the 2-year has ever seen, or at least in decades. Rapidly rising yields makes everything in the economy instantly more expensive. What the Fed would rather see and what economists would rather see is what they call a soft landing, meaning a very gradual rising of yields and a very gradual increase in unemployment and a very gradual decrease in demand. Obviously, that's not how these things work. What happens is that the Fed starts panicking because they usually act too late. So they undercorrect when we actually needed to raise rates back in 2021, and then they overcorrect when we are tackling unprecedented inflation. So if we look at the Fed dot plot, currently most of the Fed members are expecting a 4.5% to 5% terminal rate. But this could obviously change depending on what happens when the Fed raises rates on November 2nd. Are they going to go with another 75 basis points or not? Remember, an increasingly hot labor market and a very stubborn CPI rate is probably going to make the Fed go crazy again on November 2nd with another 75 basis point rate hike, could even be 100 basis points to rip the Band-Aid off. And lastly, I'll talk about Tesla real quick and what I might plan to do. I'm planning on potentially selling puts, maybe the 180 puts on Tesla, as we look at 180 being a major level of support. We are currently at a major level of support going back to June 2021. But that 180 level going back to November of 2020, we've hit that level in November, again in March 2021, and again in May 2021. I might just sell puts at the 180 level and hope to get assigned if we do see a drop in Tesla. But also picking up shares here might be one of the more optimal moves, as this area is the highest volume that we typically see for Tesla, going all the way back to that November 2020 range. If we take that range, I'll show you how I got this. If you take the fixed volume profile range and you start currently and you end at this area where Tesla has been finding support at 180, you'll see that this point of control here in the red line signifies that Tesla's point of control is around 225. And all the point of control means is that is where Tesla has had the highest volume. So going all the way back to November 2020, Tesla's highest volume has been at around this 225 range. So for at least 2 years, that is what the market deems as Tesla's fair value pricing. Anyway, traders, the summary is that we're at a pivotal point here at a 50% retracement of the last bull market. I do believe that we do have more downside in the long term. I do believe that we will see a broad-based recession, and the National Bureau of Economic Research will finally deem this a recession, especially since we inverted on the 10-year and 3-month. However, I do think this is a good spot to start dollar cost averaging on blue chips. I do think that if we do get good earnings on the mega caps going forward, we could see a face ripping rally, hopefully to the resistance of this descending wedge around the golden pocket, maybe 400 on the SPY. At that point, I will probably open another optimal short position to round out 2022 and play a 2023 downside in the stock market. Obviously, all of this is a moot point if the Fed decides that they actually want to pause or pivot, but I don't see them doing that, especially with the effective federal funds rate minus CPI still being at -4 and inflation being so sticky. Anyway, traders, sound off in the comment section below. Let me know what you think about this. Are you buying anything currently? Did you start buying stocks? Are you dollar cost averaging? Are you waiting? Are you completely on the sidelines, 100% in cash? What do you think is going to happen to the markets? Are we on the verge of a broad-based recession? I would love to hear from you. Leave it in the comment section below. If you want access to our analysis options, futures trades, if you want access to our long-term plays, etc., all of that link is in the description below. You also get access to the day trading course. You also get access to the options course. You also get access to the Zoom calls with me. There is so much value here. So link is in the description. We're about to run out of spots for October. So make sure that you apply if you really want a spot. Hit that thumbs up. Stay safe out there, traders. Peace.